Welcome back to the 21st. I'm Nyla Boodoo. We're talking about the unpaid bills the state of Illinois owes for its workers. In particular, we've been talking about healthcare bills. On the line with me is Casey Toner. He's a BGA investigative reporter. We've got some personal finance, certified financial planners who are here as well to talk about how to deal with these unexpected healthcare costs. So if you have questions for them, our phone number is 1-800-222-9455. We're going to get to that in just a minute again. 1-800-222-9455 if you have comments about if you are a state worker and you've had to pay out of pocket and want to share that story or have any comments about that, you can give us a call as well or tweet to 21st Show. Casey, just before the break, I wanted you to give you a chance to finish that thought about businesses and what you think the business impact of this is for businesses who aren't being paid by the state.
Yeah, well, what I was saying is that there are people right now that are refusing to do business with the state because they just don't know when that money's coming in. I mean, I mentioned a televisual company that had done work with the state in the past few years, but now is just refusing to unless the money is guaranteed by court order or through Medicaid or something like that. I talked to another guy that does signs, and he used to do all kinds of signs work for the state, but he just said that, right now, we're just not going to do it because, we don't know, when we're going to get paid. And then there's other businesses. There's, social service agencies that have refused to take, non-Medicaid patients because they don't know when the money's going to come in.
Right. And it's a good reminder for people that there are some bills that are required by law to be paid, and that includes Medicaid, right?
Right, yeah. And the total amount of bills right now that are unpaid represents about 10% of all the bills in the state of Illinois. And so that includes, $3 billion with the Department of Human Services and $212 million with the Department of Aging.
And altogether, that adds up to about $3 billion?
Yeah, a little bit more than $3 billion.
Thanks for that. Casey Toner is with the Better Government Association. With their Rescuing Illinois project, they've been doing in-depth reports about improving and reforming state government. Thanks, Casey.
All right, thank you.
Our phone number, 1-800-222-9455. You can tweet to 21st Show. We had a caller, Nathan from Champaign, who said he didn't actually mind paying up front because at least for a time he was getting paid back with interest more than what a bank would pay. But he says he understands why not everyone is able to afford paying up front. If you want to share your questions or comments, our phone number is 1-800-222-9455. You can tweet to 21st Show. How are you dealing with these unexpected healthcare costs? We thought we would bring some certified financial planners in to help answer questions because there are ways to manage this. In studio with me, Ben Franklin is the managing director and senior wealth advisor of Franklin Wealth Advisors in Champaign. Ben, welcome.
Thank you. Pleasure being here.
Thank you. On the line with us from Northfield, Illinois, Ed Gjertsen is actually the national chair of the Financial Planning Association. He's also vice president of MAC Investment Securities. Hi, Ed.
Hey, Nyla, how are you?
Good. Now, let's ask for folks who are dealing with this and maybe not so great. This is a situation that's been going on all year, and I think people maybe who were being asked to pay it up front unexpectedly may be surprised. There are people who have been paying up front for a while and dealing with a 9-month delay or whatever delays they're getting. But I thought we should start with a basic personal finance question, which is how you think people should budget for unexpected health costs. Ben, let's start with you.
I'll go back to a story that I was told by my great aunt back in the 1970s. She had been a saver her entire life, and she told me that her dad told her when she got her first job, every week when you get your paycheck, set something aside in a savings account, regardless of what it is, even if it's only $5. And there used to be a time when people would make a deposit for themselves and pay themselves first just a few dollars. And so I'd say the very first thing is to establish that savings habit, even if it's just an incredibly small amount of money, to start with that. Now, there are better tools for dealing with it, like flexible spending accounts, health savings accounts, Roth IRAs, that we can sure get into in detail. But just having that commitment to at least pay yourself something out of every paycheck, even if it's only a very small amount.
Ed, we know that statistically we have the lowest savings rates we've ever seen among Americans. So what advice do you have for people to even just get into that mentality of saving?
Well, I love Ben's, story about his great aunt, because I can tell you the clients that I have, and there's fewer and fewer of them from a Depression era, always saved, because that was their mentality. Their mentality was, hey, things can go wrong, and when they do, it's really bad. So those were the savers. And as we sort of have gotten well away from that era, more and more people are relying less on paper and more on plastic, which is, cash, and then more on credit. And so people are viewing their credit cards as their emergency fund, if you would. So from a savings rate standpoint, the savings rate has actually improved since the great financial recession we had, in 07, 08, 09. And that is actually a good thing, but overall, it's still very low. So we tend to spend more than we save, which in times like this, in times of uncertainty, when unexpected bills come up, put us in a really bad bind.
What's a good amount to aim for saving in your emergency fund? How much salary do you think is a good goal to set aside, Ed?
Well, it's all predicated on what you do, and it's interesting because if you listen to people, they're like, well, 3 to 6 months is great. Well, that's terrific if you're a regularly salaried employee, right? If you're in sales and you deal with a commission, then you may need to be saving more. Or if you're in a field, let's say you do trading or something where you have irregular income, you definitely need to save more in case things go south. So again, it's really predicated not only on what you have, but also what's your overhead. How many people are you beholden to in terms of your debt and things like that as well? So, there's general guidelines, but then you've got to be very specific about your own situation.
That's Ed Gjertsen. He's National Chair of the Financial Planning Association. He's on the line from Northfield. In studio with me in Champaign, Ben Franklin. Our phone number is 1-800-222-9455 if you have questions for them. And Ben, you started laying out HSAs, FSAs. Before we even get to Roth IRAs, because that's another option for people, I know particularly with FSAs for for University of Illinois employees, the deadline is actually coming up for FSAs. It's next week. Can you explain, first of all, what an HSA is and the difference between an HSA and the FSA? Let's start with HSAs.
Okay. A health savings account is an account that someone is allowed to set up to save toward future medical expenses if they have a certain type of a health insurance plan. Has to have a high deductible, has to have a certain amount of out-of-pocket limit. It can't be a limitless plan. But there's a certain category of health plans, and if you have that type of health plan, then the government allows you on a before-tax basis, a tax-deductible basis, to set aside money into an account from which you'll pay for medical expenses.
Ed, can you have an HSA and an FSA or only one?
You can have both, but you have to be very careful because FSAs are employer-sponsored, right? So from that standpoint, you've got to be very careful in terms of how you handle it and how you use it. The other side is we just talked about low savings rates. So, people are trying to save for their retirement, try to save and eat and, pay their bills and things like that. So from that standpoint, again, if it's one or the other, you've got to be very particular about which one you choose.
So would you recommend that you ask a financial planner if you are trying to do both an HSA and an FSA, it sounds like you have to be careful about what you're eligible for and what you qualify for.
Okay, I feel that was like a layup question. Yes,
Okay.
I mean, everybody should be seeking a certified financial planner. Individuals believe, well, I need to have a lot of money and a lot of wealth in order to seek out a certified financial planner. But just like good physical health, where almost everyone needs a doctor, at times you really want to seek out a certified financial planner for these questions because they're very complex and very specific to the individual and their financial situation.
And how much would it cost to meet with a financial planner for people who've never, there's different ways that people pay financial planners, right?
Yeah, there's all different ways. Some planners are hourly, some planners are on a retainer, some may charge as little as $50 a month or $100 a month. That's something that's relatively new. I know the younger generation, the next-gen planners that are out there, they do a lot of that. And for most people, that's probably a really good fit.
Ben, when we're thinking about FSAs, with flexible spending account, I think a lot of people sometimes don't do it because they just don't understand or it seems complicated and they don't know the rules of it. How does a flexible spending account work?
I think the number one fear is the use it or lose it portion of the flexible savings account. That's one of the big differences between a health savings account and a flexible saving. In essence, you can set it aside during the year, but if you don't use it all, then in essence the employer gets to keep the excess that you don't use. But the way that it works is it's done on payroll deduction, so it's the friendliest type of savings that you can do because you never see the money. It not only saves you income taxes, but it also saves you employment. Well, in the case of University of Illinois, it would save you the SERS contribution. But in another person's case, it would save a Social Security contribution. So in essence, it has a value, let's say even for the lower income people, of 25 to 30% of tax savings of the money that's actually going in. And the way that it would work is you would pay the bill, you would submit the receipts to the employer, and then the employer would reimburse you up to the amount that you've set aside for the year.
So how much should you think about setting aside for it the year?
The minimum at the University of Illinois is $20 per month. And the way that I usually talk to clients about it, and I do agree that a financial planner brings a tremendous amount of value to the average person, but I will tell you that your tax man who knows you well can also help out on how much should go into a flexible spending account. But if you know you're going to have certain out-of-pocket costs for dental, for vision, maybe for hearing, maybe for a regular checkup, those kind of things, I definitely set aside the amount that you know you're going to spend, because in essence, 25 to 30% of it's going to be paid for by tax savings.
And is there a minimum for FSAs that you have to save?
Well, the minimum, again, on
for
the
university employees,
university employees, it's $20 per month, and it's usually set up by the Human Resources Department of the company that you work for, because it is an employer-sponsored plan, and $2,500 per year is the maximum you can have go in for medical reimbursement.
And do flexible spending accounts also include expenses like you would make for childcare?
That is part of a flexible spending account, and it's a different expense category. And its limit is $5,000.
Okay, so you could set aside your pre-tax money for childcare, but would that be a separate FSA, or is it just a separate category in one FSA?
It would be a separate category within the flexible spending account.
And what advice do you have for folks as they're thinking, especially this time of year? What kind of questions do you need to be asking yourself to determine whether or not a flexible spending account makes sense for you?
Well, it comes down to a simple spending plan. I mean, directly. It's. I hate the word budget because it reminds me of the word diet, and none of us like diet, so let's call it a spending plan. Is to kind of figure out, and Ben brings up a great point. Most of us file taxes, back in April, and so what does that mean after the fact? And so are there ways of contributing to, again, whether if it's an FSA or HSA, is there a way of contributing that to help you be able to pay for this care in a tax-friendly manner? So as far as, where these things sort of lie, some people have FSAs available to them. If not, HSAs may be an option as well.
Ben, there's another option you said for unexpected, not just healthcare costs, but any costs, and that's a Roth IRA. Can you explain how that would work?
We really like to use a Roth IRA for our middle-income clients, and especially our lower middle-income clients. There are certain tax benefits that you can get with a Roth IRA that are income dependent, but even aside from those, a Roth IRA allows you to set money aside conceivably for retirement, but you have complete access to principal during your entire life for any purpose whatsoever. So we like to use it as a backup college savings plan in case they don't have enough saved for college, but they would like to pull out some money for children at a later point in time, and they don't have enough money to be able to set aside for 2 or 3 purposes. And as a backup plan for not only medical expenses that come up, but maybe the furnace that needs to be replaced, or they don't have money when a hot water heater goes out, or some type of other major expense that they're otherwise, as Ed said, going to have to put on plastic. And it's not only going to cost them the cost, but the cost plus the interest.
And with a Roth IRA, what are the maximum contributions you can make a year?
$5,500 if you're under the age of 50, and $1,000 more if you're over the age of 50, a catch-up provision.
And I wonder if there are other ways you think people should think about with, particularly under the category of unexpected healthcare costs. Are there other things we haven't talked about that people should be thinking about?
Well, whether it's unexpected healthcare costs, your car, I would not put college as an unexpected cost, right? Some clients all of a sudden call up and say, hey, oh, by the way, my son or daughter's going to college next year. Can you help me? That's not unexpected. But I think from a practical perspective, get a good idea of what you're surrounding yourself with. I mean, are you in a home that has a lot of old appliances, an old furnace, a new roof? This is all about planning. And so the challenging part is the plastic that we use on our credit cards to spend allows us not to have to plan so much until after the fact we have to think about paying that bill off. So it's just a mindset of the individual of just thinking a little bit more forward. Healthcare is so unpredictable. You just don't know what's going to happen. We're in the fact that things like, wow, I've got a car that's got, 100,000 miles on it. It's a 15-year car. Yeah, you're probably going to have car bills. So it's just being a little bit more thoughtful in terms of the future of what may lie ahead from an expense standpoint.
A quick question for you, Ben. You don't have to pay interest if you're taking out from your principal on a Roth IRA.
Right.
Now, if you're taking out the interest, then you do get hit with a really heavy penalty.
If you're taking out your gains, it's both taxable as ordinary income, plus you pay a 10% penalty if you're under the age of 59 and a half. So it's very expensive to take it out before versus after.
Question for you guys. From a financial planning standpoint, we've been talking about the state and the state paying back for healthcare providers 9% interest on how much they're owing. I'm just curious what your thoughts from that are from a financial planning perspective. Ben?
From my perspective, anytime a client can get guaranteed interest of 6% or more, I would take it, especially with as volatile as the stock market is.
Right, but I was thinking of the other way, that the state is
the
having to...
irresponsibility of the state?
Well, that the fact that they owe the money and they're paying 9% interest on it.
It's funny because we live in a state with a constitutional amendment to balance the budget. So it boggles my mind how these kinds of things can be justified. But yes, it makes no sense at all.
We're going to have to leave it at that for right now. We've got to take a break. Thanks to Ed Gjertsen, National Chair of the Financial Planning Association from Northfield, and Ben Franklin in Champaign with Franklin Wealth Advisors. Thanks, guys.
My pleasure.
Thanks, Neil.
The 21st is made possible by Kester & Bradley, LLP, providing legal services to the Urbana-Champaign community and Illinois residents since 1895. Kester & Bradley's attorneys are committed to achieving the best results for their clients. More information is available at kesterlawllp.com.